All right. Hello, everyone, and welcome to another edition of the Dividend Power Hour. It is great to be back with you on our normal schedule, Wednesday afternoons or Wednesday evenings, depending on where you're at. I'm here on the West Coast in California, but for those of you that are on the East Coast or even over in Europe, good evening to you and welcome. Thanks for joining me for this Dividend Power Hour. We have a lot to talk about. There's been a lot going on in the markets and outside of the markets, as a matter of fact. So let's dive right in and let me know, where are you tuning in from and what stocks have you bought? Have you bought any dips in the market? We've seen a kind of a pullback in big cap tech, and we've seen kind of a surge really in small caps. So not sure if any of you have been buying any of that IWM that we've talked about. Oh, and by the way, I'm pretty sure we've talked a few times about REITs getting ready to roar. And that's exactly what they've been doing here the past few weeks. So again, it's good to be with you. For those of you that are brand new to the stream, welcome. My name is Mark Roussin. I am a CPA here in the state of California. So what we do is we like to be interactive. This is an interactive group. We like to have a bunch of commentary going on in the comment section, ask questions. I'll try and answer as many as I physically can. There's a bunch of folks in the group that have been joining. There's a lot of regulars that are here. So welcome to the community if this is your first time joining. So let's take a look at the comments and see. We got is it Hogue or Hoagie from Indianapolis? Great to have you. Robert from Mesa, Arizona. Philip from Jacksonville. Matthew, good to see you as always. Sean from Singapore, good to see you, Sean. James, always good to see you in Vegas. Pretty warm in Vegas, I bet. Drew, Minneapolis, Minnesota. John Bircher, good to see you as always, my friend. We got, is it Ernie from Porta Vedra, Florida? Not sure if I said that right, but gave it my best shot. We got New York City's in the house with AJ. Drew, always DCAing that VGT. Hi, Mark. Sold some CVX. Haven't bought anything. Sunny, good to see you. More Florida. Temecula. Speaking of some heat there, I had a wedding out in Temecula a few weekends ago, and it was a warm one. Hello from Turkey. Awesome. Great to have you. Josh, good to have you. Ohio, Louisiana, Skippy's near Buffalo. We have Dallas is in the house. Upstate New York. Shiva from Texas. MDT and SOUN for Robert and Bayern. Jeffrey Hatch, always good to see you, my friend. From Washington, bought some Amazon. I love that. VIG after trimming some UNH after the big jump, and it certainly did have a nice little jump these past few days. Tomas from Miami, Florida. Hogue or Hoagie, either works. Love it. So I was right both times then. Chicago's in the house. Jeff H. from Minneapolis, New Jersey, Maryland. Is it a good time to buy the Magnificent Seven on this dip? Shiva, good question there. We'll be talking a lot about this dip here in today's session. And since we have so much to talk about, let's jump right into it. So for those of you that have joined the live stream before, these are going to be some of our update. We'll jump between the slide deck. We'll be jumping through the iPad and all around just discussing a number of different topics. So let's do our quick market update here. So the Dow Jones up 9.3%. It has had a nice little move. That has been largely due to the fact that UNH, and again, for those of you unaware, the Dow Jones is a price-weighted index. For those of you that have taken my 6-week course, you know that because we've gone through and explained that in good detail, in great detail there. So the Dow Jones up 9.3%. S&P 500 pretty much flat from the last time that we met. So again, this isn't exactly a week since the last time we had this Dividend Power Hour was last Tuesday. So today is Wednesday. So pretty much has gone nowhere, but the NASDAQ, that is actually pulled back. So we've seen that come back a few percentage points. And the Russell was pretty much flat on the year going into last Tuesday when we met, or at the conclusion of Tuesday's market. Now it is up over 10%, nearing 11%. So quite the move there. In terms of valuation with the S&P 500, again, it hasn't moved, so I wouldn't expect valuation to move. Still trading at 20 times. And historically, we're closer to about 17.5 times there. So still in this elevated area based on that 2025 EPS estimate. So that's going out another almost a year and a half. Interest rates have pulled back as well. So we saw the 10-year at 4.3 last time we met. Now it's sitting around 4.1.5. The 2-year sitting at 4.6 last week. Now sits at 4.44. So we're starting to see those interest rates move prior to that Fed cut that's coming in a few months, that I believe is coming in a few months. Inflation numbers were good. After last week's session that we had together, remember Thursday was that big June CPI report. How was inflation going to show in terms of the consumer price? And that came in way better than expected. Not way, but slightly better than expected, I should say. And now in this week, we have seen mega caps pull back and small caps surge higher there. So in terms of the fear and greed index, pretty much exactly the same. We did see it start to surge a little bit higher prior to this pullback we've seen the past few days. And now it's pretty much right back where we were the last time that we did in fact meet. So with that being said, let's take a look and head over to our iPad. So let me set up the iPad here and let's take a look at where the sector performance is overall. So hopefully you guys can see that now. So here's our sector performance, and let's start with our year-to-date, see where things are. Information technology, consumer communication services continue to lead the way there. No surprise there, but those are starting to come down a little bit more. In terms of the S&P 500, it's up 18.8% year-to-date. Financials and industrials, and now look at this. Every single sector within the S&P 500 is now green. We have got the real estate sector from being down 2%, down 4%, to now being positive by 1% there. So 1.17 there on the year. Everything is in the green right now. In terms of the 3-month, let's look. Info tech is the only. So technology is the only sector that is outperforming the S&P 500 right now. Everything else is underperforming from that standpoint. And look at what's slightly below that. Look at what is the second best performing sector in the S&P 500, something that we have talked a lot about on this channel here. And I've been talking about, hey, we don't need to back up the truck, but let's start nibbling at these cheap prices. And what am I referring to? I'm referring to REITs, real estate investment trust. Look for value. Don't always chase the high flyers that are expensive. That's how new investors get in trouble. There's a lot of new investors that have come back into the market over the past 3 to 6 months. And this is how pretty much, and I'm always here an advocate to try and help the smaller investors, the new investors. I'm not looking to help billionaires by any means. I doubt any of them watch my show. But from that standpoint there, I am trying to help us regular folks, okay? And what happens is we go through cycles where new investors chase high quality or fast growing companies at extremely high prices. I put out a video recently on Costco. Costco is a very high quality company, but look at what they've done in the past few days. The stock has tanked from that standpoint. You got to be able to separate a company from a stock price. You can love a company, doesn't necessarily mean you need to love a stock price. And what happens in these cycles that we go through, not economic cycles, but what happens in a stock market cycles is you go through these periods of euphoria. And what do the big money folks do? They sell into it. They know they are selling right into retail investors. So they are claiming their profits at the top. They don't sell it all. They do it in tranches. We'll see a little bit of a pullback, but what happens? Retail investors climb right back in. They say, oh, this is the buy the dip opportunity, without looking at valuation, without understanding how to look and analyze the company and how to go through and say, okay, this is where the stock's been trading over the past 5 years. This is where investors have been comfortable buying this particular stock at, but now it's trading at a much higher valuation. Has anything changed, or is the company growing just as fast? Are the operating margins just the same? If the answer is yes, then why should we be paying a higher price than we have over the past 5 years if nothing has changed in the business? That's what you have to ask yourself when you're analyzing, when you're looking at valuation. Because if you just start openly, just blindly investing, listening to all these people that are out there, I mean, you got Tom Lee saying we're going to have a bull market. You got Jim Cramer saying he's going against it. Someone's going to be wrong. It just depends on who you're listening to. And if you're just listening and buying, even if you're listening to me, if you're just listening and buying, that's not the right way to go about building wealth, generational wealth in the stock market. You want to find your strategy. You want to look at how to analyze a company, how to value a company. All of these things we touch on within my 6-week course. And this is so key because we could be going through one of those cycles right now where the big money is selling and retail investors are buying into it. And what are we going to see? We're going to see that rug pull moment. You usually get one correction every single year on average, at least one correction. And a correction is a 10% pullback from our highs. We haven't seen anything more than 5.5% that we saw back in April. Okay. So just be mindful of that. Make sure your portfolio is not overexposed to any particular sector as you manage your own portfolio, because right now you're getting these ideas, buy this, buy that, without even thinking about portfolio construction, you could lean into a lot of issues down the road. So just be mindful of that as you continue to build out your portfolio. So let's get back here and take a look at where have we been over the past month. Well, consumer discretionary has been leading the charge there. Amazon, Tesla have a lot to do with that, followed by financials, industrials, and look who's in fourth, real estate, up 6%. So again, you do not need to back up the truck, but we have been talking about well over a month now to say, let's dollar cost average, just start nibbling, because eventually we are getting closer to that interest rate cut from the Federal Reserve. And when rates get cut, what does it help? It helps interest rate sensitive sectors like real estate. It doesn't take rocket science once you start figuring out and learning some of these things and how cycles work from that standpoint there. So we're going to look even closer at REITs today. But before we look at REITs, let me tell you about something special we got going on right now. So if you were part of last week, we had a free investing webinar, and there was hundreds of you that actually joined that. So if you did, thank you. And if you didn't have a chance to, catch the next one, I guess, from that standpoint. So during that free investing webinar, we had launched our coaching program. So we've had one-on-one coaching for a number of years now, but I'm the only coach. I don't pass on because I feel like people build a camaraderie with me. They watch me on YouTube or they read me my newsletter or whatever it may be. I have always said I'm not going to build a connection with someone and say, oh, thanks for signing up. I'm passing you on to someone you've never met, never heard talk, and don't even know their name. Nope. I'm the only one that has done the one-on-one coaching for years now within my program. But because of the backlog that we've had, and we've had a number of folks that say, hey, would you have something more of a group coaching? We have now launched our group coaching. So it comes in at a lower price point there. We cover roughly, 80% of what we do on our one-on-one coaching. It's not going to be as intimate and have the customizable approach that the one-on-one coaching has from that perspective. And that's what that makes that one great. But this is our Investing Accelerator Academy. So right now we'll be starting this next Tuesday. It'll be every Tuesday night. You can either join us live or you can watch the recordings and take it at your own pace. We have a few spots left in terms of discount. So check out the link down in the description below if you want to take part in this. You're going to get access to it's called a Skool Community, Skool. I didn't misspell it. That's what it's called in case you're not familiar with what Skool is. It's got a, kind of a Facebook-like vibe where you can go in and talk with other community members. There's a Q&A tab. And all of the recordings, handouts, any homework items, the slides that we're going over, everything is well organized within that Skool community. So this is a great place for you to come if you're really willing and want to invest in your future when it comes to investing. If you want to learn how to analyze companies the same way I do and take my simple step approach. If you want to learn how to value companies the same way I do and look at the same 8 to 10 different metrics determining, based on which type of stock I'm looking at, we're going to cover that in this program here. If you want to learn how to build your own strategy for future, if you want to see how much do you need to invest over time to build X amount of dollars in dividend income, we cover all of these things within this particular program there. So again, there's only a few spots left at the discounted rate. Once those are gone, the prices will increase. So check out the link. Once you're ready to go, you can fill that out and get yourself enrolled immediately. So we will have all of the more information on the Skool community starting again next week. Every Tuesday is the live sessions at 8 p.m. Eastern time. So if you can join us live, great. I already know there's a number of people that won't be able to, and they're just going to be taking it at their own pace, which is completely fine from that standpoint there. So I hope you guys will be able to join us for those of you that haven't been able to jump in on the 6-week program yet. So, all right, let's do a poll real quick. An audience question here. What is your top stock pick for the rest of 2024? We've had a lot of moving parts here. So pretty much from this day forward, from July 17th, which stock do you think will outperform based on just your opinion alone? And I'll say it for all of you, not financial advice. And hopefully you guys have got a chance to watch my latest video, where I discuss what my top stock, what position I'm looking to build in as opportunities persist, or even as the stock continues to climb. This is the stock that I want to climb the ladder within my portfolio. So if you haven't checked out my latest video, definitely go back and check that out from Monday. So let me know in the section there, in the comment section, what is your top stock pick for the rest of 2024? All right, let's see what we got here. Sean said patience is key when it comes to accumulating quality REITs. I've been accumulating O for a few months. It's about as high quality as they get. Sunnyman says, I wish I did back up the truck. Yep, we can't win them all. Be greedy when others are fearful. Chips and dips from Robert Prescott. Buy beer and beverage stocks. Frank says the market is rotating. What else we got? Hoagie had a question on, looks like Sunnyman jumped in. QYLD is tech heavy, which had a pullback this week, and it's going to be very based on, number one, the positions that they own, but also the trades that they're making. So both of these are income generating ETFs, meaning they are selling covered calls. So when a lot of their, if you're tech heavy in the those tech stocks fall, it's going to make those trades a lot more profitable because you're going to be able to keep your position as well as keep your full premium there. So it's going to make those ETFs a lot more profitable from that standpoint, be able to pass on a lot more in income. Soundhound is the pick for Matthew. Okay, Matthew, if Soundhound is it, we may have to fork over one of these hats behind me here. I know you've been wanting one. EWTX. Eli Lilly is going to keep roaring for Larry Roach. Skippy would say Visa. I like that one. Magic Man Pfizer. I love that one there. We've been talking about Pfizer for about a month. There's two main themes we've been talking about a lot on terms of what stocks are really deep value. It's been Pfizer and it's been the REIT sector there. So we're talking more about Pfizer. Amazon, love it. PLD with Prologis. Sean's going with Amazon as well. Pat's going with Amazon. MPW will outperform as they close on selling some hospitals. Well, they're in the hospital business. Don't they need those? Amazon. REITs are now approaching their 52-week highs. Do you think REITs will continue to grow? If yes, I say Vici. Otherwise, I say Visa. Well, I like both of those, Vici and Visa, as a matter of fact. And I think, REITs are in the early stages. So when you're comparing to some of these 52-week highs, I mean, some of these stocks are down 20, 30%. So it's kind of take them with a grain of salt there, but, spread it out a lot longer. Look at where they've been since rates have started to increase. These stocks have a long ways to go to get to break even if you invested in them, 3+ years ago. Visa, Google, I like that one. Caterpillar, Sonny, that one's been rolling right there. I do like me some Caterpillar. Don't own any right now. Bought some ILMN. John's got some Amazon. He's been watching the videos. I love it. Meta with Google. More Visa for Jeffrey. Hello from Puerto Rico. Great to have you. Would love to see IBM and AT&T move forward. AT&T's been moving pretty good. Visa and Vici. We got Meta, Vici, or Agree Realty. So some more REIT fans there. Love it, James. Is KO too high to get in right now? We'll have to look closer at KO. JEPQ is 51% tech. Yep. So JEPB is going to be more S&P 500. JEPQ is going to be more NASDAQ related. So it'll follow kind of the triple Qs in a way. So definitely a lot of tech exposure there. Georgia's going Amazon. John said for ETFs, SCHD may do very well in the last half. Already off to a good start, especially as things broaden, especially as the tech sector falters. We expect to see SCHD do quite well there. So what did they do today in this market pullback? I didn't even look. Up 1.5%. Not too bad there overall for SCHD. So good point there, John. Christian, Vici, and SCHD. Not familiar with that company there. Dividends with Travis. Thanks for tuning in. Amazon is evil. Okay. Visa, Amazon, BMY. If the dividends are included, they are sure. We'll give you the dividends. IRM won't stop. Oh, and EPR. So we'll look at all these we got here. SCHD, SCHD, SCHD. We got some SCHD fans in the house. So awesome. Well, thank you guys for being a part of that poll there. So now let's take a deeper dive into some of this pullback that we've seen. And it hasn't just been in the last day. This is something that started to, accumulate now for, days and weeks, as a matter of fact here. So looking at the 52-week highs, and most of these companies that you see on this list here, most of them hit their recent 52-week highs because, we've gotten to this pattern where, hey, S&P 500 hits a new record, and it was kind of like a daily thing. I think we've hit like 8,000 S&P 500s in the last 50 days, it feels like. even though it's not possible. But what we're looking at here is from their 52-week high, how far have some of these technology stocks fallen? So let's take a closer look at those right now. So we can see AMD's been the big loser. This isn't as recent. This is more of a last month type of thing, but AMD has fallen 30% off of its highs. Qualcomm down 17, Nvidia is down 16, Broadcom down 16 as well. How about SMH just in general? All of the semiconductors had a rough time today based on comments not only from Trump, but also from Biden as well, talking about, trying to get more of this America first type in terms of semis and giving access or buying from certain countries and things like that. So SMH was down a lot, and the chip sectors in particular were down a lot. We had Meta down 15% off of their highs, Amazon down 6.5%, and then there's Microsoft. So Amazon and Microsoft really have been the two mega cap companies, even though Amazon's more of consumer discretionary. I like to think of it with AWS being the largest component there, still as technology based, but it's broad. Have really been holding up quite well so far, I should say, in this kind of tech sell-off that we have seen there. So it's something definitely to watch there. There is strength within those two particular companies. Apple's another one that's not down all that much from its 52-week highs at all. So, but now let's take a look at value stocks. And this is what we like to preach here, is a lot of the time is having a good blend. It's always important to have a good blend. For me, I love dividend stocks, but I don't just invest purely in dividend stocks, slow moving. No, I'm kind of right down the middle, leaning towards dividend stocks. You've seen, those of you that are subscribed to our newsletter and Edge Plus members, you could see my entire portfolio. I'm an open book from that standpoint. Alphabet has been one of my largest positions. It is my single largest individual stock position. It didn't pay a dividend until recently. You have Microsoft up there. You have Apple and Visa. All of these companies pay dividends less than 1%. People invest in these companies not for the dividend, more for the overall growth from that standpoint there. But then I sprinkle in, some higher yields and things like that, but constantly looking for value. That is the Buffett approach there, trying to weigh and not be too far to one side or the other. So let's look at some of these value stocks. Look at that. The top one that we have on our list here is Altria Group. Altria, MO, up 12%. Caterpillar, up 11%. These are over just the past month. Pfizer, 10%. Target, 10%. How about Union Pacific, 10%. Lowe's, 9%. There's AT&T, a hated stock for a long time, up 9%. And these don't include dividends. These are just share prices. With Altria, you're getting about a 9% dividend. Home Depot's up 8%. Johnson & Johnson's up 7%. Nice move with Johnson & Johnson today. Question here out in the audience: what trading platform do you use? It's a mix. It's a blend. I have mostly Fidelity. I've had I have Vanguard, some Schwab, and then some trading money in the likes of Webull, M1 Finance, and things like that. Question here: how is MO doing so well with the decline in tobacco use? And that is a great question. And that's not anything new to this business. Cigarette volumes have been on the decline for decade plus from that standpoint. But they've been kind of maneuvering their company more into smokeless, more into, they've got into, what's the technical term? Marijuana. I was just going to shoot out weed or whatnot, but let's say marijuana. So they've been kind of waiting for that. And a lot of their investments haven't panned out all that well. It's been a burn on cash, but they're looking to diversify their business because they know, just like we know. I mean, if we know it, they for sure know it, that they can't stick with the same game plan that they had 20 years ago. They need to mix that up and diversify and change that direction moving forward. And this is a stock that still has great cash flow. They still have pricing power. So even though volumes are going down, they keep jacking up the prices. And if you look at their free cash flow, they're still able to generate billions in free cash flow, which allows them to not only pay a dividend, but continue to grow that dividend, albeit slightly. So you still get a nice juicy dividend from them so far. SJ, hi, first time joining live, but was late. No worries. Thanks for tuning in. Mark, why is SC or SH, I think it's SCHW, Trevon, are you talking about Charles Schwab? They're down so much, 15% in the last 2 days. They had some earnings. So check out how they reported their earnings. And if you are an Edge Plus member, we did a deep dive on that earnings recap that you'll be getting here on Friday. Linda, Seminole, Florida. great to have you. A lot of Florida today. Florida is just, holding down the fort today. So those are a look at our value stocks. So small caps, no surprise there to old Tom Lee. Small caps and REITs. REITs is something that we've been talking about. We haven't talked a ton about small caps because usually my approach when it comes to small caps is to just invest in IWM. But they've finally broken out after largely being left behind. They have been the clear laggard every time we've had these over the past year plus. IWM's up 10% just in the past week. That's what they're up year to date. It's like 10.7, but most of that, almost the entirety of what they're up on the year came in the last week here. VNQ, which is the Vanguard Real Estate ETF, that's up 7.2% in the past week as well. So this week, the IWM surpassed RSP, which is something that you guys know I like to look at. RSP is the equal weight S&P 500. So you can kind of see how much weight has the likes of NVIDIA and Apple and Microsoft and all of those large companies been pulling. The S&P 500 is up 20% over the first 6 months through the end of June there. But when you look at it, there was 77% of S&P 500 stocks that were underperforming. That tells you just how much weight, how much those companies have pulled and made up the entire figure there. So RSP, though, can kind of show you the difference there. And we've kind of seen the biggest gap between that we've have seen in years. VNQ turned positive as we looked at the sector performance there. All sectors now in the green. Real estate was the one sector that was in the red. It is now finally green for the first time in 2024 there. So let's continue on here with REITs. REITs continue to be on the move. So these figures here are just in the past week alone. So pretty much since the last time that you and I met, we have now seen Vici, which you guys know if you've watched this at all, if you're subscribed to my newsletter, Vici is my number one favorite REIT. So if you haven't checked out Vici, and if you love Vegas, or if you haven't checked out Vici and love Vegas, then you're going to love Vici. Vici is the largest landlord on the Las Vegas Strip. They own the likes of Caesar's Palace, Mandalay Bay, the Mirage, and the list goes on. I mean, you can go on forever. You can go to New York, and other things like Excalibur and MGM Grand, and so on and so forth. Largest landlord on the Las Vegas Strip, have some of the best assets that you can find, not only in the US, but in the world in terms of hospitality and hotels. How about CubeSmart? The fact is, with self-storage, especially here in America, we're hoarders. Don't know how to get rid of things. Self-storage always has demand up 9.1% in the past week. Triple N, 8.8. How about American Tower, cell towers? That's been surging higher. ADC, we've talked a lot about on this channel. Realty Income up about 8.5%. Stag Industrial, those are back to, or 3 in a row. ADC, O, and Stag, back to back monthly dividend payers. So all three of those companies pay out their dividends every single month. PLD, another fan favorite and a favorite of mine. Prologis, 7.7%. And then you got Simon Property Group, that is up 5.5% there. So fantastic there. What is your largest REIT holding? Let me know in the comment section there what your largest REIT holding is, because I know a lot of you have watched the videos and a lot of you comment. You just commented on what some of your top stock picks were, and some of them were in fact REITs. Actually, a lot of them were in fact REITs. So in the comment section, just type out what is your top REIT that you own right now within your portfolio. That might change in the future, but as it stands right now, let me know what your top REIT is. And mine's going to be Vici and Realty Income are the two top, and then PLD. And I'm looking to get PLD to surpass Realty Income here very soon there. So let's go back to the comments here, make sure I'm not missing anything. Danielle Perez says ADP. Mark, you were so right about REITs. I'm just trying to help folks here. We're all here just trying to make us some money. If you love money, then you love Vici. Growth potential, cheap value, 6% dividend yield. I'll take all of that any day of the week. Gilda realized today I'm not diversified enough, and that's okay. And that's not something that needs to change overnight. That doesn't mean you need to go and sell half of your portfolio. But as you add new fuel to the fire, as you take money from your checking account, your bank account, and add it to your brokerage account, those next dollars that you invest, they just don't need to be in that particular sector. That's one way that you can start. You can trim some if you had some big profits, or start to understand some of the differences, or how to take advantage of tax loss harvesting. I put out a tweet today, there's so many people that want to complain about taxes that certain individuals pays, when they should really first and foremost use a lot of that effort towards understanding how they can save, understand more about the tax code. And when it comes to investing, tax loss harvesting is something that not only rich people can do, most of them do it, but any of us investors can do it. Any investor can take advantage of tax loss harvesting. It is a key when you're managing your portfolio. That is something that we're going to go through within our Investing Accelerator Academy, within the group coaching program. So, and if you haven't checked that out, definitely check it out, because we've already seen a couple of those go through where there's only a few spots left in terms of that, if you want that $500 discount there. So what do we got? Vici, top REIT. O in Maine, ADC for Sunny Man. How about more Vici? John, Vici, love it. O and Vici, only Vici. O, Investor's Edge. MPW. Hopefully you bought in late. It might not be too bad. AGNC for some high yield. Vici and O, and then MPW. Hey, Mark, at work. Just found time to get in. Awesome. Thanks for jumping in. Larry's going to go with some realty income. More MPW. Despite the turmoil, I see a long-term value on the horizon. The fact of the matter is MPW, I'm not as concerned about the assets. Hospitals, those are something that are really going to be in need for many, many years. I mean, I don't think we're ever going to get to a point where we don't need hospitals. Maybe they'll get down to where people are just getting a lot of the work done in office properties and maybe don't necessarily need hospitals, but there's always going to have a need for some sort of hospital there. My issue with MPW was the management team and their lack of vision and their lack of clarity and their lack of openness. And when I have those issues with management, that's not a stock I want to invest in. That's not a stock where I want to put my hard-earned money into those types of companies there, which is why I've shied away from MPW, and I got completely out at a great time before the full-on collapse there. Realty income, more realty income. Good to be here, brother. Realty, Blackstone, O, Vici, over 200 shares of O and Vici. Here we go, RLTY. We're starting to mix it up some. SCHH ETF. I'm not entirely sure on their agreement that they did there. I'm sure there's some rent pausing that's going to go on from that standpoint there. But I'm sure that the rents are going to tick up. So maybe they'll give them a break now, but they're going to maybe jump those up to market rents, because you're building. I don't know if you saw some of the images that they're building, but this Hard Rock casino that they're building in place of the Mirage. So for those of you unaware, the Mirage in Vegas, the old pirate ship, where people used to go and watch that is being completely torn down, and they're building up a brand new Hard Rock casino. I think that is supposed to start at the end of July, if I'm not mistaken, but do not quote me on that one there. Jeffrey's going with Vici and O as his largest positions. James with Vici as well. OHI, speaking of another healthcare one. Do you have any thoughts on EPM? It's up 11% in the last 6 days. Current dividend yield of 8.4%. I don't really follow that one all that closely, so not going to take any time to jump on that one right now. So, all right. So now let's take a look at our Fed Watch tool. So let's jump over here to the iPad and take a look at our Fed Watch tool. So here we go. Let's see, where are interest rates going? And again, many of us started the year expecting 5 rate cuts. Not a lot of us here on this channel in particular, because we said that is just, they're smoking some of that Altria Group marijuana there on that case. But 5 was way out of the question. 2 or 3, absolutely. I think we were more in the 3 camp heading into 2024. I've brought that down to still believing that we're going to get 2 interest rate cuts. But a lot of us let one CPI report kind of change everything from that standpoint. And I mentioned it back then. Don't let one report change everything. It was March at that period, April at that period. We've now seen consecutive 3 makes a trend here. And we see that CPI is coming down. We see all of the other inflation trends starting to come down, interest rates starting to have an impact and slow things down, albeit slowly, but surely there. So I still believe that we are going to, in fact, get a September rate cut and then potentially sneak in one more at the end of the year in December. So let's see where we're at right now. So the next meeting is on July 31st. So it's going to be the end of this month. And you can see that on the screen right here. 96% chance, 96.5%, pretty much 100% chance there's going to be no interest rate cut from that standpoint there. Interest rates are going to stay the same. But let's look at these probabilities. And where do folks believe, where does the futures market believe that interest rates are going to, in fact, come? Well, Here we go. Right now we're at 525 to 550. There's now a 96% chance of interest rates coming down in the August one, or sorry, in the September meeting, which is going to be the next meeting after this end of July one. That's where I've kind of been focused on. But if you look here, November has a 61% chance of another rate cut. And in December, sneaking out at a 56% chance at a third. So right now, the market has gone from last week when we met, it was 2 interest rate cuts, to now believing we could potentially be getting 3 rate cuts in a row. You will go from September to November to December, 3 rate cuts. I'm going to still stick and stay on the 2 rate cut thing here, because as you've seen, these markets have been fluctuating. We started with 5 or 6, we went to 0, now we're back at 3. They're all over the standpoint here. I want to stick with the details. I want to not overreact one way or another, but I want to look at the data as it comes out. And I'm going to stick in my 2 interest rate cut camp here. So we'll have to continue to monitor the data. However, that's where the Fed is right now. And that's where the future market is. They are predicting that we will get 3 interest rate cuts now moving forward. So definitely something that we're going to want to pay attention to moving forward. So let's continue on this theme of the CPI. So June CPI report came out. And for those of you unaware, this is an inflation reading that's out there. And last Thursday, it came out. So you can see the expectations there. MOM stands for month over month, and YOY is year over year. So those were the expectations. They expected that from May to June, we were going to get a 0.1% uptick in CPI. Well, that actually came in below. That actually decreased. And it decreased for the first time in a number of years. Year over year was expected to come in at 3.1. It came under that at 3 flat. So that was good. More importantly, though, I like to look at core CPI. Why? We pull out energy and we pull out food costs. Those are 2 highly volatile prices. You know, out here in California, you have gas for $6 and it can go down to $4, you know, and that's still expensive for many across the states here. But it was down something like 4 to 5% just in that month. So let's pull those things out and look at the core piece here. We could see month over month, the expectation was an increase of 0.2. That came in at 0.1. Year over year expectation was 3.4. That came in at 3.3. So not only did we surprise to the downside, albeit small, but we're continuing to trend lower and lower over the period. And you can see that we peaked out there in 2022. And when we were over 9.5%, that was extraordinary from that standpoint. Not great. But now we are sitting at the lowest levels that we have not seen since April of 2021. First time that we've seen the month over month decrease in a number of years as well. So that was good. So how about the labor force? How is the labor force doing? There's a number of components. We don't want to just look at stock valuations. You want to put the entire thing together. Again, things that we teach within this 6-week program that a lot of students are going to be venturing on starting next Tuesday. So if you want to be a part of our Investing Accelerator Academy, then definitely check out that link down below. Get yourself $500 off. There's only a few left there. So let's now go from inflation to the job market. How is the labor force holding up? After all, the consumer makes up 70% of GDP. If consumers don't have jobs, if consumers that have jobs aren't seeing increases in average hourly earnings, then they don't have money to spend, they don't have money to eat, and we just start to see that cycle curtail down, down, and down. We don't want to see that happen. No one wants to see that. No one's rooting for job loss, although the Fed, with high interest rates, are impacting the jobs to a degree. But they don't want to keep interest rates too high because why? They don't want to impact the economy too much. They're seeing that they're making headway on inflation, but now they have to do a balancing act and not keep them too high because they can impact inflation and bring it down, but they can also throw the economy into a whack. They could see huge amounts of unemployment. Unemployment has now surpassed 4%, up to 4.1%. That was something that was down below 3.5% not too many months ago. Now we're kind of trending higher from that standpoint. So jobless claims last Thursday, $222,000 or $1,000, 222,000 people. That was down by 17,000 from the prior week, the lowest levels we've seen since June 1st. So job market's still hanging in there. We do still have 1.85 million people that are unemployed and continuing to collect benefits. In past jobs reports, other ones that we've seen, the JOLTS report, if you don't follow that, that is the number of job openings that companies have out there. We see a lot of those job openings pulled back. We've heard about hiring freezes. We see some folks doing some layoffs there. So the job market is starting to show some cracks, but hanging in there nonetheless there. And then we have, this is our Stock Investors Edge. So if you're not part of our weekly newsletter, there's a free one where you'll get one email per week that'll go through our weekly update. It's just a one-stop shop to kind of stay up with the market, top stories and things like that. But if you want to be an Edge Plus member and get my entire portfolio, get earnings updates for all the stocks that we follow, in addition, you're going to get stock deep dives where we go in and go look at one individual stock per week. You can get yourself a free 7-day trial. There's also a link for that down in the description below. So let's go back over here to the iPad and look at a few other things that we have in store. So what else? Let me get this off the screen here. No more of the Fed. Let's look at global chip stocks. So not sure if any of you hold any ASML, but they're one of the best companies out there in terms of looking at their balance sheet and looking at their future growth. Why? Because they don't build AI chips. They build the machinery needed to build AI chips there, or semiconductor chips, I should say, not just AI chips. But today, not only on one side of the aisle, but both sides of the aisle had some commentary around chips and geopolitical chips and things like that. So you could see that ASML, which I'll show you right here, fell 12.74% on the day. That's one day, 12.74%, talking with Trump and Biden, both talking about some tariffs and not selling particular chips or equipment and things like that to companies like China. And there was commentary around Taiwan and things like that as well. So they got hammered along with the chip sector in general. You know, if you look at SMH, which is going to be a popular ETF that's out there, look at this. You don't see ETFs fall big time that much because it's thought of as a basket of stocks. It's a basket of, you know, various different stocks there. This ETF was down 7%. Look at some of its top holdings. You'll see it's all technology, but you have NVIDIA, Taiwan Semi, Broadcom, AMD. There's ASML, Intel. Intel was actually one of the few green chip stocks on the day. So if we go to Intel here, which I have it up on the next screen, they squeaked out some gains here, albeit small. And I know it's rare to see Intel in the green over the past few years because it's just been a disaster from that standpoint. Look at that 5-year chart. You invested 5 years ago in the bull market that we have seen from the S&P 500. That's up like something like 80% or something. Intel has you know, just tripped on their own feet and toes and, you know, everything under the sun, down 30% from that standpoint. So seeing a green day with Intel is few and far between, but they're kind of US based and building more manufacturing facilities here and kind of trying to impede on Taiwan Semi. So that was one reason that they were, albeit slightly green, in the face of terrible performance from the chip sector there. How about Johnson & Johnson? Johnson & Johnson's a stock. I put a video out for those of you that are Edge Plus members. You saw that I continued to add to my positions in the 140 range. And now, lo and behold, we've seen Johnson & Johnson get rolling again. Look at that chart. You can kind of see just where the support is from a technical. For those of you that love technical reading, right here, the stock just keeps bouncing off. That low to mid 140 range, anytime it bounces there, buy. It's a buy. It's been a buy. It's been a buy. This is kind of where I was buying right there because I could see the trend that for some reason, not for some reason, but for a valuation perspective, anytime that stock dips there, the valuation is quite intriguing to a number of buyers. And we see the stock never, people say, okay, it's not cheap, but when it gets down there, boom, we're buying and the stock's back up to the races. It'll come back down. You just wait, boom, buy. And that's why we always talk about taking a dollar cost average approach rather than the lump sum approach. Because had we done the lump sum approach yesterday on SMH, we'd be down 7%. Had we done the lump sum approach on ASML yesterday, we'd be down 12%. No one wants to see that the next day. So take market timing out of things and dollar cost average. You can dollar cost average on the way up. It's okay. I did it on NVIDIA. Bought some NVIDIA at 500, at 700, at 800, and it kept going up. But valuation looked fine. So I don't get concerned with a stock trading at a 52-week high if the valuation's okay. And that's why it's so important to continue to understand how to look at valuation, which is why we have that 6-week Investing Accelerator Academy for you guys to join. So again, That'll be starting next Tuesday. For those of you that are just joining or late to the party, make sure you definitely join us. If you're looking to take your managing skills to the next level, you can have a look here. Here's our Investing Accelerator Academy. Again, sessions start at 8 p.m. Eastern on Tuesday, every single Tuesday. You do not have to be there live. You can do it at your own pace. All recordings will be saved to our Skool community. All handouts and slide decks will be saved there. So you'll have access to all of that. There'll be Q&A sessions. You're going to learn how to construct a portfolio, build a strategy, but most importantly, value and analyze both traditional stocks as well as real estate investment trusts, which are completely different from the way that we do some of these traditional type of companies there. So if you are serious about becoming your own money manager and taking your investing to the next level and no longer just investing and letting the blind lead the blind, I want to get to a point to where if you watch my YouTube channel, if you watch other YouTube channels or listen to CNBC or Yahoo Finance or whatever it may be, all of those ideas that are getting thrown at you are going to be nothing more than ideas moving forward, because you're going to take them and say, okay, let me analyze those for myself. Because some of these investors may be short-term investors. Some of these investors, they have no idea what your exposure is. If you have 80% technology exposure, taking on another technology stock may not be the best bet for your particular. So everyone has a different strategy. And those are the things that you need to understand is, number one, does this stock fit my strategy? Okay, if it does, let's look and analyze the health of the balance sheet. Is it a liquid company? Can they pay their bills if they all came due tomorrow? What are the operating margins looking like? How efficient does management run this particular company? Okay, great. It passed those tests. How about now we go look at valuation? I like the company. It fits my strategy, but is it a good time to buy? Is it a good time to hold? Or is it in fact a good time to sell? Those are the things and the steps through our valuation checklist that we go through in that 6-week program. So hopefully I've given you guys enough information to digest and get signed up for that program. It's going to be fun. Again, it starts next Tuesday there. So, all right, what else do we have in store for you guys? There's one more that I wanted to show you in terms of small caps. So this is on Market Watch here. So it's a free site that you can go to. But so this is Market Watch talking about interest rate cuts and then looking here at small caps, mid caps, and large caps, because we know what's on the horizon. It's not likely that interest rates are going to go higher. It is very likely that interest rates are going to start getting cut here in the near term. So in the first 3 months after, this is showing after the first interest rate cut, after rates have been elevated for a number of months and years, what happens to small caps, what happens to mid caps, and what happens to large caps? Well, as you can see here, small caps get a jolt. And we've seen that already begin. Tom Lee talked about it last week on CNBC, saying this is just the early stages of this bull run in small caps. These are his words, I should say. But looking at the data here, you can see that after the first year, this is going from 1963 to 1994. We saw small caps outperform, up nearly 11% after the first rate cut. And then after the first 6 months after the first rate cut, that continues up to 14.2%, again, outperforming mid caps as well as large caps. And then when you look out over the next year after that first rate cut, we could see that small caps on average up nearly 26%. And that's right around that 30% mark that Tom Lee had alluded to on CNBC last week when he said, hey, we could see a 30% run up in small caps. This is that same data that he was looking at there. So mid caps, also a great spot. And I don't think anyone's going to complain about that large cap being up 15.6%. So again, markets look forward. They're forward looking. It's less about what you did for me and more about what you're going to do for me in the future. So what questions do you guys have? That's all the information I have for you guys in today's Power Hour. So if you have any questions in general about the Academy that's coming up, do drop those in. I'd love to answer any of those, get you some more information. What do we got? Let me scroll back up here because you guys had a bunch here. Would you buy a call option on SCHD? So when it comes to SCHD and some of these, dividend focused ETFs, there's just not a lot of liquidity. There's not a lot of volumes when it comes to options. So there's not a lot of option to be made when it comes to SCHD and VIG. Now, if we're talking about SPY and we're talking about QQQ, that's an IWM, that's completely different. Those ones you can play with options a little bit more there. What do we got here? Mr. Mark might know more about the impact. I'm just assuming the market will go crazy after the first cut, but I could be wrong. It might be priced in. That's probably a late back and forth that I'm getting into there. What else you guys got? Wow, 172 watching. We're up over 185. Don't worry there. Unemployment rate over the next couple of months will give a huge indicator of how bad the underlying economy actually is. The Fed most likely have waited too long. So they may have waited too long, but the fact of the matter is they were late to the game. So they cannot be early here. Their hand is kind of forced here, because if they move early, they risk inflation rising again. And then we're right back to where we started, which would just crush the overall stock market. If you saw rates come down, stock market climb, they say, oh, wait, 2 months later, inflation's getting out of hand up. We're up to 6% on CPI or something crazy. We're increasing interest rates again. Then we're going to be in a higher for longer even period than we are expected to right now. So yeah, they are likely going to be later than they are going to be earlier from that standpoint. But we'll have to see there. There are cracks, as we alluded to, with the overall economy in general, as well as the labor force there. So what else we got? AMD is killing Intel and has been for a few years. Absolutely. Buy low, sell high. Name of the game. Linda's going with O. Robert is late. That's all right, Robert. That's why we have the recordings. You can go back and watch it. I think O is a great 2025 play. Well, we should start building up that position now then, maybe. So is S&P and NASDAQ up or down tomorrow from here? Well, Scott, my magic 8 ball stopped working a long time ago. So for me, I'm always taking a long-term approach, buying high-quality stocks and ETFs at great valuations here. So as we alluded to and as we saw at the start there, the S&P 500 trading at 20 times, historically trades at 17.5 times. So with that elevated prices, you are kind of in this price to perfection moment. Heading into earnings, that's a tough spot to be in, because you are pretty much already priced to perfection. If earnings don't come in line, or even worse, they come in below expectations, you could see a stock market that can get very volatile. So I've been looking to do a lot of option plays to kind of put on some hedging per se for my portfolios, all risking a couple $100 here and there to hedge some downside protection. So, those are different ways that you can kind of utilize options to that degree. Hello, what do you think of AMD? I think AMD has a fantastic future ahead. I think there's a big time computer cycle, super cycle, I should say, that's coming online with all of these AI related computers and things like that. And AMD is going to be big, not on the phones, but they are on the computers and things like that. So, I think they are creating a fantastic product. I think they have a lot of growth, good margins, get that free cash flow continuing to rise. They're reinvesting a lot, but that's turning into future growth. So that's okay. But hopefully that it turns into more and more growth, and we could see free cash flow increase. We could see free cash flow margins and things like that increase over time. But I am a big fan of AMD. Hey, Mark, any ETFs that track the Russell 2000 that you like? Again, for small caps, I just use IWM. So there's a number of different small cap ETFs that are out there, but IWM is a low cost fund out there. I don't track a lot of individual small cap stocks myself, so that's the best way for me to go about it there. Will the market cool because of rate cuts? I think it won't necessarily cool. We could get a pullback. I don't think that's necessarily due to rate cuts, as I believe it's due to broadening out. I believe it's a lot of portfolio managers coming in and saying, okay, some of these stocks have ran its course. A lot of these stocks I'm sitting in gains. And the thing with growth stocks is you could sit on huge gains, but they're not going to turn into true gains until you sell them. There was a lot of people that had, nice gains in Nvidia heading into 2022. Well, Nvidia fell 75% at one point in 2022. Those gains are wiped away, and there's a lot of people that sold at the bottom. Now we V-bottomed, and it's up hundreds and hundreds and hundreds of percent. So we're seeing a lot of those big-time money managers say, hey, let me take some profits here. Look at valuation first. We don't want to sell a stock just because we're at a big gain situation. There could be some rebalancing. So there's different rules that different ETFs and money managers go by. So there's a whole number of different reasons, but there's a lot of undervalued stocks. As I mentioned at the start of today's program, is the fact that there was 77% of S&P 500 stocks that underperformed the index. Many of them are in fact red or in the single digits in the green there. So barely green, even though the market was up 20% 15% in the first half, had a fantastic year. Much of that had to do with the likes of the mega cap stocks, the Mag 7 stocks there overall. So definitely there's a number of different routes to go as an investment manager. Vanguard small cap. Yep, there's another one right there. How will you approach the REIT sector with potential rate cuts and the uptick after this past week? So the uptick's coming off a very big bottoming. So they still have a long ways to go, and I believe it's in the early innings there. But it's something that I've been mentioning along the way. You can go back to any of our Dividend Power hours saying, don't back up the truck, but you're going to look back 12 months, 24 months from now and say, I wish I bought more fill in the blank of a high quality REIT. I wish I bought more PLD. I wish I bought more Vici, Realty Income, Agree Realty. Those are the ones that I specifically like from that standpoint because they're trading at great valuations, extremely cheap. But why are they so cheap? Interest rates. We know the sector is interest rate sensitive, and we know that interest rates are coming down. That will give some pressure release to a sector like REITs. So, you don't just need rates to come down. We obviously need the economy to hang in there because if rates come down, but it's due to the fact that the economy's performing so poor, well, then you're going to have businesses going out of business. And if businesses go out of business, they can't pay their rent. We have high vacancies, and we're right back to where we started for real estate. But if you look at a lot of millionaires and billionaires that are out there today, self-made, a lot of them have some sort of connection back to real estate. So this is yet another way. And there's no right or wrong way to approach real estate, but this is another way to diversify your portfolio and get that real estate exposure. Please do a video on ADP. Noted. Question here from Magic Man. How long is each meeting? Are we just covering stocks or what else is included in the Investing Accelerator Academy? So we start with more construction, portfolio construction, talking about ETFs, index funds, growth stocks, dividend portfolio. We'll go through my compounding calculator and things like that. That's really going to be the beginning there. But then we transition into analyzing REITs. What are the things we want to look at in a balance sheet, an income statement, and a cash flow statement where I can quickly analyze a company, go through my checklist to determine it is safe. There's nothing worse, especially when you're investing in dividend stocks, to know that, oh, that's the yield. How do I know that yield's safe? But more importantly, how do I know that yield, that dividend isn't holding back a company? Again, I love receiving dividend income. I love investing in dividend stocks. But if a dividend is holding back a company, that's not a dividend I want a part of, because dividend investing is a total return investment strategy. The yield is just one part of that. We also need share price. We need the company to continue to grow. We want to hit on both sides of the aisle there. So those are the things we go through. So once we go on REITs, then we go into more traditional stocks and we look at analyzing those companies, very different than a REIT. And we go into ultimately valuing. What are all the metrics that I look at? What are those metrics? How do I calculate them? How do I use them? What do they mean? And then we put them into practice and start looking at real life examples. Let's go look at Apple. Let's go look at NVIDIA, CrowdStrike, Johnson & Johnson, AbbVie, whatever it may be. We usually take a poll of what stocks the company or the cohort wants to look at. I bring over all of the information ahead of time, and we're going to go through my valuation tool showing exactly how you can value a stock on your own. So that'll be one of the handouts as well that we give and go through within the course there. So good question. Tom Lee is a man that is hard to go against. So if you told me, hey, you got two choices, you could have Tom Lee handle all your money, or you could have Jim Cramer. It's probably going to be Tom Lee. Both of them have definitely helped retail investors over the years, but Tom Lee has been right more than he's been wrong. So that would be my answer there. What do we got? Catching up, going through all these fast. How about Starbucks? Is Starbucks a buy, Mark? I think Starbucks is going to be fine. I think they're getting some increased pressure. Dutch Bros. I just visited a Dutch Bro out in Arizona this past weekend. Long lines every time I go there. And I've been going to some Starbucks and lines haven't been as long. So I think they still have a bit of a traffic issue, but I think, management needs a little bit more time. Brand new management team trying to incorporate some new strategies here that may or may not have been working. They kind of look like they have not been working. But I want to give someone more time than just a year to step into that role, which is a very tough role to do it. Is $50,000 on the stock market at 27-year-olds good? Absolutely. Absolutely. That is fantastic that you're at that point there. And the key is to not let up. And what I tell people often is it's not as much about the money that you invest, especially those that are new and at an early age. Start building out the habit, build out a process, understand how to value these stocks and construct a portfolio that can build wealth based on and match the risk that you're willing to take as an investor over a long period of time, because the money will come over time. If you're in a job that continues to increase year over year, and you find ways to lower expenses year over year, that's more money you could be putting towards the stock market. But if you already have the education piece down to where you understand how to do that, when you get more of that dry powder, more firepower to take and invest into the stock market, you're off into the races. But far too often people jump into investing, trying to do it on their own and just investing blindly. And it just takes one bad stock to see all of that wiped away, and you're behind the 8 ball and underperforming the S&P 500 for year in and year out and year in and year out. And then the folks come to me and take the 6-week program. And the number one answer I get for everyone that comes through the program is, I wish I knew this 10 years ago. I wish I knew this 20 years ago for the older folks that come into it. We had people that were over 70 years old that took this course. I've had people that are below 20 years old that have taken this course here. Obviously, two completely different strategies here, but they still wish they all knew this information sooner rather than later there. So don't wait on understanding how to do and how to value and truly analyze companies. It'll take it a long way. Vici ADCO PLD. Money certainly does not ever sleep there. Probably way ahead of the vast majority of 27 years. I would definitely agree there. Awesome. So I think I got through all of those questions. So again, thank you guys so much for joining me on today's Dividend Power Hour. We had a huge crowd out there today. We had a ton of people, a lot of great information here. We're starting to see small caps start to roar. We're starting to see REITs start to roar. So hopefully you guys will take advantage of that one-time discount that we have with our Investing Accelerator Academy. It's our new group coaching program. We'll meet once a week for 6 sessions. So it'll be a 6-week program, usually about 60 minutes in length is each session there. There'll be handouts and all of the slides, all of the recordings. If you cannot join us live, we'll all be on there. Q&A sessions, areas within the community to chat, ask questions. It's going to be a great time. So hopefully you'll be able to join us for that. Again, thank you guys for joining our Power Hour today and for supporting the channel. Please hit that like button down below. I really appreciate it. It shows Google and YouTube that you appreciate the videos as well. And we'll see you in the next one. Take care.